So hi everybody, my name is Daniel Cohen and I take care of product management for the Fraud and Risk Intelligence Suite. And today what I'd like to be talking to you about is the impact that digitalization is having on the financial industry and specifically the consumer financial industry. How we see this evolving and obviously what we can do to mitigate this impact and obviously protect our customers and our financial institutions. So I'll quickly begin with the modernization drivers, or why this industry is so fast moving into the digital era. And I think that when you look at the different industries out there, the financial industry is the fastest evolving industry on the planet. And it's primarily driven, one, by the consumer demand. Secondly, by the fintechs and all these startups that are popping up to deliver that demand. And third, we're also seeing the governments and the regulators, the different regulators around the world, also taking action to, number one, make banking more easy, and number two, help the consumers achieve more visibility into their banking accounts. Now, when we talk about consumers, and when you think about yourselves as humans, obviously our 24-hour day is getting shorter. We're trying to do a lot more things, and the way technology helps us is to do things for us, automate things for us, and make sure that in that 24 hours that we have, we can accomplish more. And we see a lot of things happening, from a demand perspective. Customers and consumers want easier access to their money. They want to be able to spend their money in easier ways. They're moving away from that physical banking experience into more of a digital banking experience. And they're placing a lot of stress and pressure on the traditional banking systems to deliver on that promise. While the big traditional players are trying to move up and deliver this experience, obviously we're now seeing the fintechs pop up. Companies like Paytm, we think about Paytm and how they've changed the way that we can spend our money, how easy it is now to pay for a tuk-tuk or a rickshaw or a taxi cab. We pull out an app, we scan the barcode, and we're now seeing these technology companies that are pushing forward to allow this digital era to take place and give the consumers that experience that they're looking for. And the governments are also, they're not just sitting by the sideway looking at what's happening, they're also very active. And here, specifically in India, when we think about the UPI, the Unified Payments Interface, that's also trying to drive peer-to-peer payments in an easier fashion and help consumers, again, use their money in easier ways. We look at other parts of the world where we see the regulator enforce stricter payment regulation. When we think about Europe and PSD2, forcing the banks to be a lot more, or deliver a more secure payment interface, but also driving the banks, and this is an important element of it, driving the banks to open up into third parties via API. So forcing the banks to open up application interfaces to allow third parties that access into the consumer bank accounts. And as this is happening, and we look at this evolution of banking, and we think about banking over the years, so it used to be the banking was very physical. We'd have to walk into the branch to do our banking, go into the door, walk up, wait in line to the teller, and do our banking. Then the bank said, hey, you know what? Don't come to the bank. Just call us and you can do your banking on the call. And again, it's doing this for the sake of giving the consumer a better experience of banking. Then the internet is invented and the bank pops up a website and says, hey, you know what? Don't call us. No need for human interaction. Just log on the web page and you can do your banking there. And then, an iPhone is invented and the mobile era pops up and the bank develops an app and says, you know what, don't worry about logging in from your computer, you can do your banking anywhere. But as this digital evolution or revolution is happening, and we're now seeing these APIs pop up, the real challenge is around authenticating and understanding who this user is on the other side of this transaction, or this entity that's performing the transaction. Because when we think about the APIs and the automation that they can afford a consumer, it means that there are different pieces of my entity. So I have my wearable, my smart wearables, I'll have my automated assistants, my personal assistants, virtual personal assistants that are doing things on my behalf. We can think about Amazon Alexa, for example, that's sitting there in my kitchen listening to the conversation. I'm having a conversation with my wife. We're talking about the fact that, people are coming over to watch the game tomorrow. We don't have any beer. Amazon Alexa hears that, orders the beer for me, and then a drone delivers the beer on my front porch. Now, all these technologies exist. The workflows, to enable that automation are going to happen in the next few years. But then, from a transaction perspective, who is actually transacting? Because I didn't request that transaction directly. My personal assistant, in this case Alexa, understood the context of my conversation and decided to save me time and order something for me. So the Internet of Things and the impact that that's having on who is transacting on my behalf is also driving a lot of challenge in the industry. And also we have to remember the bad guys. And so the bad guys, this is a post that we picked up from one of the dark web forums that we're monitoring. The bad guys are also looking at this evolution of APIs and how they're opening up and enabling interaction with consumers. So the bad guys are now leveraging these APIs to perform very automated attacks against financial institutions. If it's account checking, if it's payments, automated payments. But they're obviously also looking at this, and this, again, is another element that's driving a lot of stress and angst in the banking systems. So the question is, with all this happening, right, the digitalization trends, these automations, the APIs, the bad guys and the pressure that they're putting on us, how can we now rise up to this challenge and protect our consumers and the payments? How can we make payments safe? And that's really where the concept of omnichannel plays a very significant role. Because when we think about the consumer experience is already omnichannel. They're using all these different devices. If you think about Netflix, for example, you can watch a show on your TV, pick up your iPhone, and the show will continue as if there was nothing happened. You don't have to search for the point that you were at. You put down your iPhone, you pick up your iPad, again, the TV show continues, so my experience is omnichannel. So if our customers' experience is omnichannel, obviously our fraud prevention also has to be omnichannel. And when we think about the bank's anti-fraud journey or how anti-fraud has evolved in banking institutions, it used to be very, very siloed. So for every one of the channels, right, for every point of interaction that I had with a customer, I deploy some kind of solution, some kind of anti-fraud solution that would identify fraud in that channel and hopefully prevent fraud. And so for every one of the channels, the branch or the call center or the IVR, the online channel, so for each of them I'd have a vendor that was doing anti-fraud. But as a consumer is becoming omnichannel, we need a more omnichannel experience for the anti-fraud measures. We need our anti-fraud systems to have that holistic visibility across all channels. So again, we can better understand how our customer is actually interacting with the bank. Because again, remember, our customer is not just a physical entity. It's a whole mesh of devices and assistants, et cetera, that are acting on behalf of this physical identity. And so really what we've done in our portfolio is release adaptive authentication for Omnichannel, which actually provides that holistic fraud risk hub that enables you to do risk analysis across all the different channels and manage your fraud risk from a single pane of glass. And adaptive authentication from Omnichannel not only replaces existing solutions, but it also augments solutions. So if you've already invested, and we understand that fraud is not something that you can fight by yourself, it's something that we have to fight together, and we understand that in some channels there'll be very good detection, and so obviously we want to leverage that domain knowledge within a channel, and we want to augment that with visibility from across the different channels. So this is all fantastic in theory, but how does it work in practice? And what I want to talk about is these two case studies that we've done, two proof of concepts that we ran with two of our very large customers, one of them in the USA and another one in Europe. In the first POC, and this is again a large financial institution based in the US, what we did is we wanted to mix data from two channels and see how that mix improves our fraud detection rate. And in the case of this institution, they wanted to test the call center channel. And again, if you're familiar kind of with how fraud has recently been moving, so cross-channel fraud is now a very high priority problem that financial institutions have, and specifically going across from the call center to the online channel. So the way the attack looks is a fraudster will call the call center and represent himself as a customer, request that maybe the PIN code or his password be reset, somehow get that password. Either they've already, they own your email address, they might have phished your email address, and then once they have that reset, they'll then go into the online channel and empty the bank account. So that's one example of a cross-channel attack, which this financial institution wanted us to test. And so over a period of, in this case, it was a 3-week POC, a proof of concept, where we pulled data from the call center, from the call channel, Anything from the velocity of the phone call. How many times was the phone call made? Was authentication successful on the call center? We pulled that data, meshed it into our online channel data, so what was happening on the online, and wanted obviously to measure the impact on our fraud detection rates. And this is what we saw. So over the course of 3 weeks, we saw a 2% improvement in fraud detection, which is, again, when you think about the industry, it's a phenomenal increase, 2%. Think about PSD2, frictionless flows, how the regulator is forcing banks to hit the very low fraud detection rate bands. A 2% increase is huge. And in this case, for the 3-week POC, we saved an additional $44,000. And when we think about a yearly and annual basis, give or take about $500,000 in additional savings that were made, that were created or found just by meshing 2 channels, the phone channel and the online channel. I also want to mention that the savings are only on payment activity. So these are actual fraudulent payments that we stopped. There was a dollar value obviously assigned to the payment, but we also saw improvements on the login activity. So as a fraudster was trying to now log into the online banking site, we were able to detect and stop the fraudster at login. But at that point, we did not have a financial value, a number assigned to the login, and so we actually did not include login, the value of a login in our assessment, but I'm sure you can guess that that will just push the additional fraud savings up. So again, the call center, and to me this was a very interesting POC, because at the end of the day, the call center is a very analog, old-fashioned channel, but having knowledge from this analog channel and seeing how it impacted the digital channel, to me was a very interesting POC. So that was the first one that we did. The second one that we did was with an EU-based, European-based financial institution. And in this case, he wanted to see the impact of e-commerce transactions and online banking transactions. So those were the 2 channels. In the case of e-commerce, this particular bank has a pay-by-bank channel where basically you pay online e-commerce transactions with your bank account. And so we wanted to see the impact that that had, the knowledge that, gaining the knowledge from the e-commerce channel, how would that impact the web channel, and this is what we saw. So the POC was a 9-week POC in this case, leveraging different pieces of information that we could pull from this online e-commerce channel, anything from IP-related data, ISP-related data, geolocation-related data, and again, we measured the impact on fraud detection rates for the different bands that we had. And this is what we saw. This was the results. And in this case, again, on payment activity only, we were able to generate an additional nearly $250,000 on an annual basis, so $131,000 for the 9-week POC, and a 2.7% FDR improvement, fraud detection rate improvement. Now, being a European bank, this was very significant for them. So when we think about, again, the PSD2 regulation, so to those not familiar with the regulation, the Payment Service Directive, basically the regulator, in order to allow a bank to offer frictionless flows, right? And just taking a step back, so what does a frictionless flow mean? It means that we want to allow our customers to transact without the need to challenge and step them up and bother them as they're trying to buy something. So the regulator is limiting the amount of money that a consumer can spend based on the bank's fraud detection rates. So if the bank's fraud detection rates are high, the consumer can only spend 30 euros without being challenged. Once the consumer spends 31 euros, the bank has to challenge the user. And obviously that's a terrible customer experience. So that's a way for the regulator to force the issuers to improve their fraud detection rates. And so 2.7% for them was a very significant improvement. So 2 fascinating POCs, and again, this is only from taking 2 channels and crossing 2 channels. When we think about omnichannel, really the impact that we want to start seeing is how do we see the impact of 3 or even 4 channels that are crossing paths, and how does that impact the fraud detection rates. By the way, this European customer, we now have a project in flight with them. Again, with PSD2, so PSD2, that same regulation is also forcing the banks to open up to APIs and allow third parties access via APIs. And that we're now running our fraud model on that new channel that we're deploying there on the API channel, which is also going to be very interesting, and I hope to report on that next year. And then we're also deploying the branch and the call center. And again, that's also a thing that I'd like to report on next year, just seeing how all that data from across the channels improves our fraud detection rates. So what are the key takeaways for the presentation that you should really remember and take with you? So number one, if you're a financial institution, you have to accept that digitalization is happening. And if you don't take your business into that digital forefront and offer your customers that digital experience, it's not going to the future's not going to look good for you. And so we have to accept that digitalization has happened. We're going to be forced into digitalization by the regulators. The fintechs are going to push us into digitalization. So we have to accept this is happening and start planning our anti-fraud strategy to meet this challenge. Second, authentication is going to become more challenging. We spoke about this. As things start interacting on my behalf, and by the way, I always like asking, who here has seen the Google Duplex demo? The Google AI? So you should definitely, after this session or after the summit, make sure you go online, look for the Google Duplex demonstration. Fascinating demonstration of an actual AI, an artificial intelligence, that calls up and does things on my behalf. So they make an appointment for a hairdresser, they call and book a table at a restaurant, and the humans on the other end actually don't know that they're talking to an AI, to a bot. So it's fascinating that this technology already exists. And as we think about all these technologies and all these things, again, authenticating is going to become very difficult. Who is this thing or entity that is transacting on my behalf, right? And really the answer and the key takeaway is that omnichannel visibility is the way to go. Because omnichannel, at the end of the day, allows you to understand and see the customer across all the different channels that they're interacting, understand what legitimate behavior looks like, what legitimate transactions look like, and better assess the risk of fraud as we open up more and more channels for our digital consumers. Thank you very much.